Welcome to Microfinance Podcast, bringing microfinance to your screen. This episode is produced by MicroSave together with ShoreBank Exchange.
The reason credit risk management is essential is because the loans outstanding, your loan portfolio, is your largest asset on your balance sheet. Therefore, it can offer the greatest risk to your financial institution. So credit risk management, which includes the tools that help you measure, mitigate, monitor your credit risk, are important to use, are essential for any institution. A financial institution needs to be monitoring the credit risk so then they can identify any problems, any issues in its early stages. I think it is very important that you set up your credit risk tools and department prior to you disperse your first loans. You need your credit risk management mitigation tools established, such as your loan policy and your analysis templates developed prior, so that your lenders and your entire loan department understand the risk and also have structure and guidelines to what they should be underwriting. I think the most important tool to use, that management should use, including senior management all the way up to the board, is portfolio at risk reports that will look at your delinquency in a series of time periods. And you should be able to produce this report with a touch of the finger. What I mean is that you will not need any manual manipulation of the data to come to it. If you need to do something manually, then there's the chance of human error or even fraud. What is the second most important risk management tool? In my opinion, loan review is an important credit risk management tool. And what this is, it's not a got you. It's not either the audit department or a loan review department going in and trying to get the lenders. It's trying to understand if there's any systemic problems with the underwriting or documentation in a loan portfolio. You should be trying to understand, are the loan agreements signed and in the file? Has collateral documentation been completed correctly? But it should also be looking at the adherence to the loan policy. You should be looking at about 15 to 40% of your loans outstanding annually. And you should be looking at a diverse assortment of loans. You should be looking at diverse assortment by size, by lender. You could also be looking at problem loans as well as performing, and by product. So the third credit risk management tool I want to discuss is risk ratings. Risk ratings, similar to a PAR report, will let management and the board of directors understand if there's any deterioration in its loan portfolio, and then be able to look back and pinpoint if the deterioration is in a specific type of product or from a certain lender. So with risk ratings, you're going to be risk rating your large loans annually and your problem loans as they deteriorate. So therefore, if you're doing that, you're going to be annually risk rating a significant portion of your loan portfolio. So then you can look at the weighted average risk rating and understand if it goes up or goes down depending on your risk rating, if there's any deterioration. And many institutions also tie their loan loss allocation back to the risk rating.